Welcome, good people. Welcome, good people. This is ATD 1, and its introduction to financial accounting, April 2022 paper. April 2022 paper, question 3. So that is the question. Let's do it very fast. Explain 3 factors that cause property, plant, and equipment to depreciate. Explain 3 factors that cause property, plant, and equipment to depreciate. Now, 1A, solution. There are so many reasons for depreciation. We'll just mention but a few. But the most obvious one is we have wear and tear. Wear and tear is as a result of the continuous usage. Continuous usage. Every day we use them, they wear and tear. Every day we use them, they'll not remain in the same status they were before we use them. So there is always that, the part of the asset that we will lose as a result of engaging it in active activity, and that is what we call wear and tear. The asset will not retain its same status before being used as after is compared to after it has been used. There's always some change, and that's what we call wear and tear. So wear and tear is the loss of value as a result of continuous usage of an asset over some time. That is one of the key reasons of depreciation. The other reason for depreciation is obsolescence. And obsolescence is simply as a result of new ways or new trends or new technology coming into play that renders the previous technology useless. Previous technology becomes useless. So this is obsolescence is as a result of improvements in technology or improvements in the way of doing things, or new trends that come in and basically make the previous ways of doing things useless or less useful, so that people now move to newer ways of doing things, either conveniently or in terms of affordability or something like that. So obsolescence is as a result of new technology emerging, which renders the previous technology non-economical or as not as useful as it used to be. So that can also be a reason for depreciation. The other reason for depreciation is just lapse of time. As time goes by, the asset loses its value. And so that can be a reason for depreciation. As time goes by, definitely the asset loses its value, whether it's being used or not being used, and that can be a reason for depreciation. The other reason is depletion or exhaustion. And this is where the asset in question just gets used up, especially when we talk about things like land, and we are maybe getting some minerals from it, and then the end, when we finally come to the end, we finish or we complete or we exhaust those minerals, then we say the minerals have basically, there is depletion or exhaustion, and so that the value of that land automatically drops. So depletion or exhaustion of whatever item you are getting, or whatever item of value you are getting from that particular plant, property, or equipment, when it gets over, then we simply talk of depreciation as a result of depletion or exhaustion of whatever it is of value that we're getting from that particular item. Market trends or non-use of the property can also be a reason. Non-use, where the property doesn't have any more use. And we've also talked of market trends, which closely related to obsolescence, but may not necessarily be the same. So we have, as a result of non-use of the item or the changing market trends, all these could be reasons for depreciation. The most obvious ones and the most the ones that you should most likely use in this question are wear and tear, obsolescence, and depletion. Those ones are very strong. So mention any three of them and you'll get your 6 marks. Explain what they are. Then the 12 balance of JJ Enterprise as at 31st December showed a difference which was posted to a suspense account. Draft final accounts for the year ended at 1st December 2021 were prepared, showing a net profit of 94,480,000. The following errors were subsequently discovered. So you have these errors. You are required to come up with journal entries without narratives necessary to correct above errors and show the effect of each of these adjustments on the net profit in the draft financial statements and the correct profit and loss for the year ended at 1st December 2021. Okay. So let's just come up with the journal entries for this, and this is part B of the question. So journal entries. How do we prepare the journal entries? Journal entries will have to come up with let me cross my line, hope I'm able to get it right, like that. And then you have the debit side. And you have the line, that's a journal book. So you have the lines like that. And then, like that. So this is debit, this is credit. Then of course we'll have now the rest here, particulars here. So these are journal, we want to pass journals to correct the errors. We've been told there are errors, so we want to pass journals to correct these errors. The following errors were subsequently discovered. Sales of 700,000 to J. Kim had been debited to J. Kim. This is an error of commission, wrong. This is wrong account but same class, wrong account but same, all of them are debtors. So sales of 700,000 to J. Kim had been debited to J. Kim. So the sales were made to J. Kim but debited to J. Kim. So they are supposed to be debited to J. Kim. So we'll simply come here and say debit J. Kim with 700,000 and credit J. Kim with 700,000 because it was wrongly debited to J. Kim. So we are crediting J. Kim so that to reverse the transaction, and then we put it to the right person, who is J. Kim, at 700,000. So that's how it will be to correct error of commission if you were to come up with a narration, but the question is not very keen on narration, so just stop it at that. Then we go to the next item. A payment of 650,000 for rates had been entered on the debit side of the rates account as 850. So this is just a wrong entry, a wrong figure that has been passed on one side. A payment of 650,000 for rates had been entered on the debit side. That's correct, should be entered on the debit side of the rates account, but it had been entered wrongly. It had been entered as 850 instead of 650. So there's an overcast of 200,000. So what are we supposed to do to reduce this, to correct this? So we have to credit this account by 200,000. So we'll come here and say debit suspense account, because it has affected one side of the account, suspense account 200,000, and then we credit the overcast what? Rates account. It was rates account. So rates account 200,000. So these are debit entries. So when we credit the rates account with 200,000, we are simply reducing this figure by 200,000 so that it goes back to 650,000. And since it has affected one side of the ledger, we normally talk of the suspense account, which is the double entry part of that transaction. Then the sales journal had been undercast by 4 million. Sales journal had been undercast by 4 million, which means we have not introduced, or we posted a transaction less 4 million. So what do? We simply correct this error, and we correct, because sales is a credit entry, we credit the 4 million. So we are going to debit the suspense account, debit the suspense account, debit suspense account, 4 million, credit the sales account. It was under cash, so we are posting it to the sales account, and sales account is a credit entry. So you post it to the credit entry, and then you debit the suspense account. If only one ledger is affected, then definitely the suspense account will come into play. But if you have all the 2 ledgers, then the suspense account will not feature. Purchases from J. Tara amounting to 1530 had been received on 31st December 2021 and included in the closing inventory at that date, but the invoice had not been entered in the purchases journal. Purchases from J. Tara amounting to 1530 had been received on 31st December 2021 and included in the closing inventory at that date, but the invoice had not been entered in the purchases journal. So what we have not done is just to pass the invoice had not been entered in the purchase journal. So it's just the invoice that has not been entered in the purchase journal, and that's the part that we are interested in. So what do? We create that. Purchases is a debit account, so we are going to debit the purchases account and then credit the suspense account. Debit purchases account, debit purchases account, to enter that invoice, and then credit suspense account, because the other account was okay. Remember, it was entered and captured, and it was even captured in the closing inventory. So purchases from J. Tara amounting to 1530 had been received. They were received and they were included in the closing inventory. So this one is okay. It's only the invoice that had not been entered in the purchases journal. So we enter the invoice, and this is a debit. The invoice had not been entered in the purchases journal. So we enter the invoice, and the invoice is a debit entry, like that. So repairs to a machine amounting to 780 had been charged to machinery account. This is an error of principle, wrong class. So repair to machine, all of them are debits, but they are 2 different things. This machine, this is an expense. So repairs to machine amounting to 780 had been charged to machinery account. So we have to correct this. Repairs to a machine amounting to 780 had been charged to machinery account. So we debited machinery account instead of debiting machine repairs account. So we are going to credit machinery account and debit the machine repairs account. So I'll come here, and we always start with the debit side. So we'll say debit machine repairs account, 780,000, and credit machinery account, and this is 780,000. So it had been posted on the machinery account, so we are crediting it so that you can reverse the transaction, and then we post it to the right account, which is machine repairs account. Machine repairs is an expense, machinery account is an asset. So that's the difference. And then we forgot to put the figures here, purchase and suspense. Let me just get the figures. Purchase, the figure was 1530. So 1530 and 1530. Okay. So number 6, a check for 3 million being rent received from JK which had not been invoiced had only been entered in the cash book. A check for 3 million being rent received from JK had not been invoiced, had only been entered in the cash book. So in the cash book, we have shown it, we've received. A check for 3,000 being rent received from JK, which had not been invoiced, had only been entered in the cash book. So it is the rent received account that has been entered in the cash book. In the cash book, we've shown that we have received it. So the equivalent account is the rent received account. So the rent received account is supposed to be credited, and it has not been credited. In the cash book, we are supposed to debit, show that we've received. It had only been entered in the cash book. So it's the rent received account that has not been updated. So what do? We come here and credit the rent received account. Rent received is an income, and incomes are a credit entry. So we simply credit that account. So we'll say debit suspense account and then credit rent received account. Rent received account. So how much are we talking about here? This is 3 million. So 3 million. 3 million, 3 million like that. So that's how it goes, 3 million, 3 million like that. So we have corrected all the errors. So what is remaining is show the effect of each of these adjustments on the net profit in the draft financial statements and the correct profit or loss for the year ended that. Show the effect of each of these adjustments on the net profit in the draft financial statements and the correct profit and loss for the year that. So we are supposed to show the net profit is 94,480. We'll come here and say net profit is 94,480. And this is whose books. It's always good to start with the heading. This is books. These are books of JJ Enterprise at 1st December 2021. JJ Enterprise that was 1st December 2021. So JJ Enterprise corrected income statement at 1st December 2021. Like that. So net profit is that. Then we look at, we want to correct this net profit. Show the effect of each of these adjustments on the net profit in the draft financial statements and the correct profit and loss for the year ended December 2021. So what is the effect of this? This one has no effect. So no effect. This one will have no effect on profit and loss. Why? Because it's an error of commission, and the data will apply in the statement of financial position. And the only mistake here is that now it is according to the books, it was Kim who was owing. It was Kim who was owing, I think. Let me just check. Sales of 700 to Kim had been debited to Kim. Actually, it was Kim who was owing business money, and in real sense, it's supposed to be Kim. So that was the mistake. So this one doesn't affect the P&L. Let's look at this other one. Rates. Rates have been, there was an overcast of 200,000. So rates will be reduced by 200,000. Rates will reduce by 200,000. So if rates reduce, expenses, if expenses reduce, what is the effect? the effect of reduction in expense is increase in expense will reduce the net profit. So reduction will increase the net profit. But first of all, I think before we go to this, the best thing is to, normally when you talk about net profit, let's first of all work with the incomes and gains. Do you have incomes? I think there's an income here, rent received. Let's go straight to rent received. Rent received. What is the effect of rent received? This one has the effect of increasing the, it has the effect of increasing the net profit, because normally what we do is gross profit plus rent plus incomes, and then we less the expenses. So if we have left an income out, it has the effect of reducing the net profit. So now that we are adding it back, it has the effect of increasing the net profit. So we say rent received, add it back. This is 3 million. So we talk about 97. Or rather, let's just proceed. We add back rent received. Then let's look at, since we don't have any other receipt, we go to the expenses. So rates have been rates have reduced by 200,000. If there was an increase would lead to will reduce the net profits, but a decrease has the effect of adding to the net profit. So we'll simply talk of this is rates. We add back this. We are going to add back 200,000. And in fact, the best way of handling this is you can have another column here, and then all these things that require adding back, you can have them here, so that just to make your work look good. So have them here. We are adding them back. Rent received, adding back. Rates, adding back because it's a reduction. We had overcast. And then what else? Sales. Sales will have the effect of, it was an undercast, so it will have the effect of increasing. Sales will have the effect of increasing on our gross profit and also increasing our net profit. So we add sales, undercast sales. Undercast sales. How much is that? Undercast sales, 4 million. So 4 million. Let's overcast. Okay, what else? Machine repairs. This one had been omitted completely. It was not captured, so it's an expense. So it has the effect of reducing the net profit. It has the effect of reducing the net profit. So machine repairs 780. Machine repairs, this is 780. Something like that. So let's get the total here. This is 7.2. And then this will give us 101,680,000. Then machine repairs, we have it there. And I think that is the end. Those are 1, 2, 3, 4, 5, 6. So 1, 2, 3, 4, 5. We've said this first one doesn't have any effect. So machine repair will less. Okay. So what we are saying is that we have machine repair. Instead of putting it here, since it's the only one, we can just have it here, 780. Just show it there, 780,000. This will give us 101, 680,000 minus 780,000. That gives us 100, 900, like that, 100,900,000. That will be our new profit. So 780,000 machine repair. I think it was 780,000. Let's just compare to be check to be sure. I think it was 780,000. Yeah, 780,000 charge to machinery. So what we are saying is this, that this is the correction, that if this is our net profit, then an undercast in sales will definitely increase the gross profit, which will have an effect of increasing the net profit. And so you can see we've added to the net profit. Then rent received that had not been entered anywhere will have an effect of increasing the net profit, because it will be added back to the gross profit and it will have the effect of generally increasing the net profit. Then rates overcast. Overcast simply means that we had increased the expenses, and so we reduced the net profit. So we add them back so that we increase on the net profit by the level or the magnitude that we had reduced. Then machine repair, we had left it out, and this is an expense. An expense always has an effect of reducing the net profit. When expenses are high, net profit reduces. So this one had been left out, so we include it in, and when we include it, the expenses will increase, and that will mean that the net profit will reduce. So that is the whole thing. This is our new profit, as per the corrected P&L. So this is the new net profit. Thank you, and let's meet in other questions, subsequent questions. Thank you so much.